Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Forecasting Techniques, a practical guide to better decision-making. Market research techniques. Surveys and interviews play a central role in market research-based forecasting. They tap directly into consumer preferences, behaviors, and intentions, offering real-world data that numbers can't always capture. This method is especially useful when launching a product or exploring a new market. Here's how these techniques work. Surveys. A broader audience is asked questions through online forums, phone calls, or paper handouts. For example, a clothing brand might survey customers to gauge interest in a seasonal collection. Responses can reveal patterns, such as what styles or price points are most appealing. Interviews. These involve deeper, one-on-one conversations with targeted participants. While more time-consuming, they're rich in detail and context. A company designing software for small businesses might interview users to understand feature preferences or frustrations. Market research doesn't just provide numbers, it gives context. Surveys produce measurable data like percentages, while interviews paint vivid stories behind those figures. Together, they help forecasters predict shifts in consumer demand, preferences, or market trends. But here's the catch: the quality of this data depends on who you ask. A poorly designed survey or interview, or choosing the wrong audience, can lead to misleading results. It's about asking the right questions to the right people. By using qualitative tools like these, organizations can better understand their audience's mindset before making decisions. It's less about hard data and more about hearing the voices of those who matter most. Quantitative forecasting methods. Quantitative forecasting relies on numbers, patterns, and relationships to predict the future. Using statistical tools and models, this approach analyzes historical data to estimate what's likely to happen next. It's like solving a puzzle where every piece of data fits together to form a clearer picture. Unlike qualitative methods, which depend on opinion or intuition, quantitative techniques are rooted in measurable facts. When applied correctly, these methods lead to precise and reliable forecasts, making them a go-to option for businesses, governments, and industries. Below, we'll explore 2 key approaches: time series analysis and causal modeling. Time series analysis. Time series analysis looks at data collected over specific time periods to uncover trends, patterns, and cycles. It treats past behavior as a guide for future outcomes, assuming that understanding history can reveal predictable patterns. The method breaks data into these main components. Trend, the long-term direction of data, whether it's rising, falling, or stable. For instance, a company may see steady growth in annual revenue over a decade. Seasonality, recurring patterns tied to specific timeframes, like higher retail sales during holidays or increased energy use in winter. Cyclical movements, longer-term fluctuations influenced by external conditions, like economic booms and recessions. Random variation, unexpected, irregular changes caused by one-off events, such as a natural disaster or political upheaval. Time series analysis finds these patterns by using tools like moving averages, exponential smoothing, or complex models like ARIMA, autoregressive integrated moving average. Businesses often rely on it to forecast demand, sales, or production needs. For example, a retailer might analyze past monthly sales data to predict when demand will peak. If the data shows higher sales before holidays, they'll stock up inventory ahead of time. It's like looking at a calendar, knowing when to expect certain events. This method works best when historical data is consistent and reliable. However, it can't account for sudden disruptive changes, like market shifts or unforeseen events. That's why understanding its limitations is essential before making decisions. Causal modeling. Causal modeling digs deeper by examining cause and effect relationships. It's not just about spotting trends but understanding why they happen. This method uses variables, factors that affect outcomes, to create forecasts that explain how one change influences another. Here's how it works. Identify variables. Pinpoint the factors that affect the outcome. For example, a company might study how advertising spend impacts product sales. Establish relationships. Analyze how changes in one variable, e.g., ad budget, lead to changes in another, e.g., revenue. Build a model. Use statistical tools like regression analysis to create a formula predicting outcomes based on variable changes. Causal models are powerful for making predictions tied to specific actions. For example, an airline might use fuel prices as a key variable when forecasting ticket costs. If fuel prices are expected to rise, ticket prices will likely follow suit. By understanding these relationships, decision-makers can anticipate challenges and adjust strategies. This approach is also valuable in broader contexts, like public health or environmental planning. Governments might use causal models to predict how changes in pollution levels impact public health outcomes, helping them shape policies. One limitation, however, is the need for accurate data and a clear understanding of relationships. Misidentifying variables or failing to account for external factors can result in flawed predictions. Still, when the data is solid, causal modeling gives a deeper insight into not just what will happen, but why it will happen. By combining time series analysis and causal modeling, organizations can better address future uncertainties. Together, these methods balance the simplicity of patterns with the complexity of relationships, providing clear guidance for smarter decisions. Choosing the right forecasting technique. Selecting the right forecasting technique is essential to produce reliable predictions. The process isn't one size fits all, it depends on your goals, data, and context. Considering key factors like available data, forecast timelines, and accuracy needs will help you make an informed decision. Let's explore these elements in detail. Data availability. The choice of a forecasting technique often starts with the data you have. Without the right data, even the most advanced models fall short. Ask yourself, do you have enough historical data? Is the data clean and reliable? For rich historical data, quantitative techniques shine here. Methods like time series analysis or regression modeling rely on patterns within large datasets. If you have years of sales numbers, customer trends, or performance metrics, these approaches will deliver solid results. For sparse or no data, consider qualitative forecasting. If you're dealing with new markets or product launches, historical data may not exist. In such cases, expert judgment, focus groups, or market surveys can fill the gap. The key is matching your data's quality and quantity to the method. Poor quality data leads to poor forecasts, no matter how sophisticated the process. Think of your forecasting technique as a recipe. It's only as good as the ingredients, data, you use. Forecasting horizon. How far into the future are you looking? This forecasting horizon has a big impact on the technique you choose. Short-term forecasts and long-term projections need different approaches. Short-term forecasts. Techniques like time series analysis or moving averages are ideal for predicting daily or monthly trends. They focus on immediate patterns, such as weekly inventory needs or next month's sales. Long-term forecasts. Methods like causal modeling work better when you're planning years ahead. For example, forecasting energy demand over a decade requires understanding broader factors like population growth and economic changes. The longer the timeline, the harder it is to predict with accuracy. Over time, variables increase, and trends may shift. Choosing a technique suited to your horizon prevents overcomplicating short-term forecasts or oversimplifying long-term plans. Accuracy and validation. What's more important, speed or precision? The need for accuracy varies by project, but no forecast is useful without validation. Testing models helps ensure predictions align with reality. To achieve accuracy, use backtesting. Compare past predictions against actual results. This measure shows how well the forecast would have performed in the real world. Check for error metrics. Metrics like mean absolute error, MAE, or root mean square error, RMSE, reveal how far the model's predictions deviate from reality. Remember, a forecast doesn't need to be perfect, it just needs to be close enough to guide decisions. Over-focusing on precision at the expense of usability can bog you down. Balance accuracy with practicality and always validate your approach before finalizing decisions. By understanding your data, timeline, and accuracy goals, you can pick the right forecasting technique to fit your needs. Each factor plays a unique role, and balancing them will set you up for success. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.